Good morning, everybody. Good morning, everybody, and welcome to Fonti International. As you can see, we have a new timetable. We're going to be on air from now on in the very near future, ahead of the opening bell, which is the best timing for all our traders and, of course, all our viewers. I just wanted to show you very quickly the U.S. futures so far pointing higher open. Of course, after White House trade advisor Peter Navarro has clarified that U.S.-China Phase 1 trade deal is not over and that his comments to Fox News was taken out of context. Here are the futures. Actually, Dow is jumping more than 300 points so far, 1.15% in the green, S&P 500 104% in the green, and Nasdaq Composite 0.7% in the green territory. A very quick look also at European trading sessions so far pretty well after extremely positive macro data that is certainly giving some hopes to investors and of course traders. Very quick look at the German DAX so far, 2.71% in the green, CAC around 1.73 in the green, and the Italian FTSE MIB 1.70% in the green territory. Very quick look also at the bond market. Certainly extremely interesting situation over there. As we can see, the US 10-year Treasury is yielding 0.72, the 2-year 0.20, and the 3-month 0.14. The spread between the Italian BDP, the 10-year Italian BDP, and the German Bund is so far 174 basis points. Extremely interesting situation. I just wanted to kick off with several major stories today. One of it is regarding Apple, of course. Let me show you the stock, which has been hitting new record highs in the last few days. If you have a look at it, this is the yesterday's closure, 2.62% in the green. Apple announced new software for its iPhones, iPads, Macs, Apple TV, and Apple Watch. It also said future Macs, including one that will launch later this year, will use chips made by Apple instead of Intel. Apple said the transition from Intel will enable the company to offer faster performance on its laptops and desktops. Apple also introduced iOS 14, the latest version of the iPhone software, which includes updates such as the ability to set a default mail app or browser app, a redesigned home screen, and new lightning software programs called App Clips. The new software was announced in pre-recorded video filmed at Apple's campus. Apple's CEO, Tim Cook, acted as a master of ceremonies, briefly introducing Apple employees to present new features. Apple's WWDC conference is being held remotely this year due to the COVID-19 pandemic. Before the presentation started, Cook addressed the current protests against racism, including a mention of Apple's 100 million program to fight racial injustice. So certainly this is a major story that we're going to discuss with our guest, our first guest for this new beginning for Fonti International, Matthew Malley, Managing Director at Miller Tabak. Good morning, Matt, and thank you so much for joining us.
Thank you, Alex. Looking forward to the new show. It's great.
Very happy to have you back on the show, Matt. I want to kick off with the U.S. indices. Here are the futures. As we can see, all of them are indicating higher open. How do you explain the fact that Nasdaq is definitely outperforming the Dow and S&P 500?
Well, it's positive on one hand, but there is one concern, is that it does show, I think, that the narrowness of the market is returning. People just don't have the confidence that the economy is going to rebound in a real significant way, at least or back to the levels that we saw before the pandemic. So they're going into the stocks that they can rely on. Oddly enough, you never think of the technology stocks as being defensive plays, but right now they are, because they will work well even if the pandemic sees a second wave, especially the big mega cap names that work so well coming out of the lows in March. And you see this also in the gold market, where you see gold is back up near its multi-year highs, up near 1750 or slightly above that. So you can see that people are like, yeah, I want to be in the market, but I also want to hedge myself a little bit. So I'll buy these big cap, mega cap tech names and hedge myself with a little gold.
Last week was definitely a roller coaster for the U.S. markets. What do you expect this week from the U.S. trading stations? Why I'm asking, because we have many interesting stories also from political point of view. For instance, White House trade advisor Peter Navarro has clarified that the U.S.-China Phase 1 trade deal is not over and that his comments to Fox News are taken out of context. Of course, we saw also the tweet of President Trump, who of course said that the deal was fully intact, which is something certainly very positive. What do you expect from the markets?
Well, I think this volatility is going to continue for a while. I mean, we seem to be, the White House seems to be trying, or they want to go back to this thing that they played last, this little game they played last year, where they would go back and forth between being tough on China and then saying that the deal was in good shape, and then going back and forth. This one kind of blew up in their face a little bit. They tried to go tough on China, and it had an unbelievably negative impact on the market. The futures sold off in a significant way, and it forced them to immediately come out and say, no, everything's okay. And the reason why this is such a volatile thing is that the Chinese are basically taking advantage of the U.S. right now, because the Chinese believe strongly that President Trump isn't going to do anything to disrupt the stock market before the election, and this has given them much more confidence to push hard in several different areas. I mean, we saw it first with Taiwan, then of course in Hong Kong, and more recently on the border with India, and it could still be an issue also with the tensions seem to be rising between North Korea and South Korea. So. At some point, if China pushes too hard, President Trump is going to be forced to push back, and that could really cause the tensions to increase. So, as you mentioned, there's a lot of different issues that can create keep volatility high going forward.
Matt, I just wanted to talk about Apple because the story that we saw yesterday is certainly extremely important. They have a great ecosystem that right now is completely fulfilled. What do you think about this, if we can call it separation with Intel?
Well, it seems like they can do no wrong right now. I mean, one of the things, it's away from what their actual fundamental outlook, and of course everybody's talking about the impact that 5G will have going forward. But you walk away from the fundamental issues, and you see that again, on a technical level, the stock has broken out above its January, February highs very nicely, and so that kind of breakout is we have a lot of this is very much a momentum-based market, and this gives it even more upside momentum. That's number one, and number two, as I just mentioned, is a stock that should hold up even if if it turns out that we get another wave of the coronavirus, and even though I don't think we'll get a complete lockdown like we got before, we could see a self-imposed lockdown by many businesses and individuals, and Apple's going to benefit from that as well. So people just see a lot of where they feel like it's a win-win for me. I can buy this stock, which is a great company and a high flyer, but it's also a defensive play if things turn bad.
I was wondering, this additional closure of Apple stores, do you believe this is going to have a negative impact on the sales, or you think this is not going to be any circumstance?
Well, I mean, no, I don't. I mean, unless it becomes a widespread situation. We saw what the impact it had on the stock market last week when people started worrying about, geez, if companies start doing a self-imposed lockdown, that could cause some problems. But again, with this, this thing is we got some pent up demand, I think, built after the whole lockdown in the global economy, and with the 5G coming out, yeah, it could hurt their very near-term results, yeah, but I mean, I'm talking about the next couple of weeks, not couple of months. That's the only thing that would be hurt as we get past, into the fall months and 5G and things like that. That pent-up demand will become unleashed, and it should help the stock.
Are you bullish on the tech sector? Because as we were talking at the very beginning of the program, NASDAQ is definitely outperforming the rest of its peers, which is certainly surprising. Do you believe this is going to be like that in the long run?
Well, to be honest with you, it's not great for the long run. It is positive over the short run because I mean, people are. It's the group where momentum is going, and when the momentum is higher, that's obviously positive. But again, we're returning to that what we saw just before the market saw a big hiccup a couple of weeks ago with this really narrow market. We saw it yesterday. I mean, you got a stock market. The Nasdaq was up 1%, was up over 1%, and yet the breadth, the advances versus decliners was almost even, was almost flat. So you can see that it's just a small. We're returning to that situation where only a small number of names are taking the market, the Nasdaq higher, and I think that over the long run, that's just something that's not sustainable.
I just wanted to have a very quick look also at a currency market over there. We also saw extremely interesting movements, especially of the dollar index, which is off 0.40% right now at a 96.63 mark. What's your take on the greenback?
Well, I mean, there's no question it's becoming very vulnerable. I mean, we've been talking about for so many months how good it had been, and if you get this bounce off the lows of early June, early to mid June, was a feeble one, and it's starting to roll back over. If we take out those lows. Below 96, it's going to raise a very strong yellow warning flag. If you drop below the March lows, which is that's way down at 94 and about 94 and a half on the DXY dollar index, that's going to send some real serious red flag on the dollar. Although you look at that, it will be very positive for emerging markets and some commodities. So the dollar, I mean, the one thing about the stock market and the dollar, the correlation can be very, very different. I mean, we have many examples where a higher dollar has been associated with a strong stock market and vice versa. So it's not a real strong correlation for the broad market, but it could be for U.S. assets, and some of these foreign assets will look a lot better.
Matt, very quick take also on the gold. Do you believe this is very good momentum for the precious metal?
Well, it's certainly it's like anything. We always want to make sure it gets a what they call a meaning for a significant breakout. Right now, it's $10 above that key 1,750 level, 1750. That's a nice move above its old highs. That's taking it out of its range. It has to go a little bit more. I think get it up near 1775. But once you get a confirmed breakout in gold, I think the upside is going to be very quick to the old highs above 1900. So again, this is the markets right now are very momentum based, and if gold can see that a little bit more meaningful break of that key resistance level, it's really going to take off.
All right, thank you very much, Matthew Malley, Managing Director at Mirror Tobacco. Have a great day.
You too.
Well, before we go ahead with our next guest, I just wanted to show you very quickly a stock to watch, and this is certainly a wire card because it's been a roller coaster period for the stock. By the way, I just wanted to highlight that it's recouping some ground. If we have a look at it, almost 30% higher. Former Wirecard CEO Marcus Brown has been arrested on charges of inflating the company's balance sheet. Prosecutors in Munich said earlier today. Brown resigned on Friday after the German payment service provider said auditors at Ernst Young couldn't locate 2 billion euros of cash on its balance sheet. On Monday, the company said it was likely that those funds do not exist. Prosecutors said that Brown turned himself in on Monday evening and would be brought to an investigation judge on Tuesday, which is certainly today, who will then decide whether he should remain in custody. Before we get our next guest, I just wanted to show you very quickly also the energy market. We did see a major deal today. So far, the U.S. oil is trading 1.70% higher. If we have a look, trading well above the $40. So far, $41.24 per barrel, and the Brent $43.54 per barrel. Let me talk about a major deal today. A consortium of 6 global investors has entered into a $20.7 billion agreement with Abu Dhabi National Oil Company. As part of the agreement, the group will invest $10.1 billion to acquire a 49% stake in a newly formed subsidiary. ADNOC gas pipeline assets with lease rights to 38 pipelines. ADNOC will hold a majority stake of 51% and will retain ownership of the pipelines. It will also manage operations and remain responsible for capital expenditure. It is the single largest energy infrastructure investment in the region and the largest in the world in 2020, according to Abu Dhabi National Oil Company. It is also part of the UAE National Oil Company's strategy to attract foreign capital and maximize the value of its assets. I just wanted to remind everyone that the Italian SNAM is within this consortium. This is going to be very interesting. It's the only company that actually knows very well the operation process. Now, in order to break down this story, I just want to bring to the show my next guest this morning, Youssef Al-Shamari, Editor-in-Chief, Sea Markets. Good evening. Good morning, Youssef, and thank you so much for joining us.
Hello, Alexander. How are you?
Very happy to have you back on the show, Youssef. I was wondering, what's your take on the deal? I mean, do you believe this is a significant deal for the industry?
Well, absolutely. If you look at the UAE and its economy, it's one of the most attractive economy in the Middle East for foreign investments. In fact, the United Arab Emirates is on track to become a net gas exporter. And that's why I believe the deal, which has taken 6 large companies to purchase this or to make this new ADNOC gas pipeline asset, will be such an important deal towards achieving that target, while assuring the markets that the UAE will also be a attractive environment for foreign investments that the United Arab Emirates is actually very much well engaged with.
And do you believe this is going to be a positive?
Well, in many ways, I think it's excellent to have foreign investments in your country, and regardless of the targets that they are trying to achieve. I think it will have a remarkable impact on the UAE economy as a whole, moving it from an economy that, especially in Abu Dhabi, an economy that continues to be very much driven by oil, to an economy that is diversified into natural gas and other foreign investments. So certainly, I think it will be very good for the UAE economy and for the whole industry investing in that gas pipeline as a whole.
Well, let's get back to the crude oil. We do see some positive movements today over there, of course, after White House trade advisor Peter Navarro has clarified that U.S.-China phase-wide trade deal is not over, and that his comments to Fox News was taken out of context. So certainly China is extremely important for the crude oil market, no doubt about it. So far, WTI is trading $41 per barrel and Brent $43 per barrel, both trading higher by more than 1.5%. This Tuesday morning. What's your take on the market? What do you expect from now on? Do you expect a lot of volatility as we saw in the past few months?
Well, absolutely. This morning we have published a report on oilprice.com, and we've been actually debating a case for a $50 price in the second half of 2020. Certainly, economies now are not. And the case of the pandemic now is much better situation to what we saw in the second quarter of this year. Fundamentals are strengthening. We continue to see tighter supplies, especially from the OPEC plus cuts and the North American supplies. And demand is recovering. Currently, demand is set to have reached 90 million barrels per day in June. With what we've seen in the JMMC meeting, the Joint Ministerial Committee meeting of OPEC Plus that took place last week, we have seen very good compliance set at 87%, with countries falling to or that have fallen behind their targets will be compensating for all the missing targets in Q3. That includes Iraq, Nigeria, Kazakhstan, as well as Angola. In fact, these countries have even all submitted their plans, practical plans that show a roadmap towards achieving 100% compliance by September. So I think this has all been factored in the markets now. We also, if you look at the U.S. oil supplies, it's now 1.7 million barrels less down compared to last year. Current U.S. supplies stand at 10.5 million barrels a day compared to just close to 13 million barrels in 2019. So that's have all being factored into the economy. In fact, also the market is not expecting a reimposition of lockdown measures as what we saw in Q2, despite continued spread of COVID-19, despite warnings by WHO of fears of a second wave of the virus. Yet we also continue to see the number of recovery in cases globally continues to rise dramatically. Also the number of deaths from the virus is also declining. And that has been, that's something very important. That's what we currently see in the markets now.
If we use the crude oil as a proxy for the economy, what would be your assessment of the current situation?
Well, crude oil market is certainly improving compared to what we saw in beginning of Q2. We're still in the Q2, but the market is in a much better shape now. It looks to be on a promising directions. We still think that demand will recover, and the demand recovery will be associated with economic recovery as a whole and across all the economic sectors. Certainly, crude oil continues to be a major indicator for the healthiness of the economy. Just look at when the oil price deteriorated in April and May. We have seen all the stock markets in New York and elsewhere all making significant losses. We've seen many companies, major companies, filing bankruptcies. And I believe the recovery of oil markets now continues to be reflected on other markets, especially the U.S. stock markets.
Certainly. I was wondering, what's your take on the majors? What do you expect from their, quarter earnings?
Quarter earnings for oil companies?
Yeah, all the major giants.
There's been some significant hits in Q2 and even Q1 earnings due to the downturn of oil revenues. Yet, I think many companies have taken several measures over the past period in terms of spending efficiencies. We've seen many companies that have cut down the number of staff by a significant amount. Just look at BP. They've reduced the number of staff by about 10,000 people. And many companies have also taken similar steps in order to reduce the cost, although that's not certainly not good news for many people working in the oil industry, but just reflecting this on the revenues of the company. I think they will be in a better shape compared to what we saw beginning of the year, where it's driven mainly by the recovery in oil prices. Yet, I still think that many projects will not come on a stream now. The oil price is not at a very high, sufficiently high level to drive a lot of the expensive projects that oil majors actually operate in the Gulf of Mexico and in North America and many other places around the world. That needs a price of at least some would need a price of $20 to break even. Some would need $40. So I think we still continue to be a better recovery in the prices in order to improve the economic returns for oil majors in Q2 and Q3 and even throughout the second half of 2020.
Youssef, one final question. How important for the crude oil market is the trade relation between U.S. and China?
Certainly, it's an important, has got a very important role to play. Yet, the impact of the trade relations now is not as. I don't see that being factored in on the markets compared to its impact back in 2019 when we didn't have the COVID-19 crisis. The markets had that as a major factor to be worried about. And today, this morning, there's been some good tweets coming from the U.S. president of kind of assuring the markets that that the agreements between the two sides is still valid, and China will continue to deliver its commitments in terms of buying products from at certain amounts from the U.S. So I think the current state of the deal is not in a bad shape. I think it's in a good shape currently to keep the market recovering.
All right. Thank you very much. Youssef Al-Shamori, Editor-in-Chief, C Markets. Thank you so much for joining us. Have a great day.
Always a pleasure, Alexander. Thank you for having me.
Well, we're heading for a very quick commercial break, but stick around because we have many surprises for you in the next part of the show. Welcome back, everybody. Futures are indicating very positive opening. If we have a look at it, actually 29 minutes to the very beginning of the trading session, to the Tuesday trading session. So far, Dow is up more than 290 points, S&P 500 102% in the green, and Nasdaq Composite 0.7% in the green territory. So far, pretty positive picture in terms of trading session in the U.S. White House trade advisor Peter Navarro has clarified that the U.S.-China Phase 1 trade deal is not over, and that his comments to Fox News was taken out of context. President Donald Trump swiftly confirmed on Twitter that the deal was fully intact. My comments have been taken widely out of context, Navarro said in a statement from the White House after Fox News reported him saying that Trump had decided to terminate the trade agreement. Certainly this scared the markets, no doubt about it, but so far a lot of optimism over there. I wanted to show you also very quickly the European markets. So far the German DAX 2.61% in the green, CAC around 1.77 in the green, FTSE MIP 1.82 in the green, and FTSE 100 1.32% above the flat line, which is certainly fantastic. Also, one of the reasons for this optimism here in Europe is the macro data that we saw this morning. We're going to discuss it, but in a few minutes. First of all, I want to bring to the show my next guest this morning, John Ergas, Chief Economist, Tigers Financial Partners. Good morning, John, and thank you so much for joining us.
Thank you, Alexandra. It's always the greatest honor. Thank you very much.
Jean, I just wanted to kick off with a very brief comment on how do you imagine the U.S.-China trade relations, because what we hear on TV is completely different compared to what we see from the press releases later on.
Okay, I think it's a very important point is to understand what is trade in the U.S.-China relationship. I mean, the U.S.-China relationship goes well beyond trade, and trade, in our view, has always been a subset of this global, much larger relationship, which is really about politics and power plays and the great game and the reestablishment of some type of equilibrium in the post, let us put it this way, original Cold War world. Will that interim have been settled at Yalta, and sort of through trial and error and almost a nuclear conflict had held, we are now struggling and seeking another equilibrium, and the trade discussions are just one part of it. So I think the point is basically this. First, we have always had relatively low expectations of any final bargain with China on trade. I mean, we see this as just one subset of a much wider fight. We've always seen these agreements as one-off, modular, and not part of a process. They are a finite event. This is not flow. It is not necessarily going to be that you do step one and then we do step two and then we do step three and so on and so forth. Let's do step one and let us consider them all independent events. Next point is that the enforceability of these agreements is extremely limited, abstracting when in fact it really is a question of political clout. What I mean by this is simply this, is that we can complain all we want that China is not actually doing what it said it was going to do. And they can say, well, look, we had a very big crisis. How can you expect us to, commit in this situation and so on and so forth? But the fact is, what can the U.S. do? Okay, very little. Are they going to invade China? Are they going to bomb Shanghai like in the 19th century? No. So basically what we have is this, is we have trade as a venue for continuing discussions in the midst of growing tensions at a higher level. And this is something we see a lot in political negotiation, that whilst, the door appears to be closed at the top, between the leaders, and there's acrimony, and they accuse each other of spreading terrible viruses. You're responsible, no, I'm responsible. You're responsible, no, you're responsible, so on and so forth. At a lower level, they're desperate to keep the door open. So we see trade discussions as having an intrinsic value going well beyond, let us put it this way, the subject matter. Subject matter is an excuse to keep talking. We saw this also during the Cold War. We saw this during the Second World War, and we saw it in a lot of other situations. Countries are not going to close that door. So I think that Navarro's comments were most probably taken out of context. I think what he might have meant was something like, well, don't expect us to do much more, and we don't expect much more out of them. But I think basically the question is this, is who needs who most? I think Trump needs China much more than China needs Trump. There's going to be elections in the U.S. I am not aware, maybe I've been out of the loop, as they say, that there are going to be presidential elections and a challenge to power in China in November. So basically, who's campaigning? We are. Who's not campaigning? They are. Who's firmly in power? They are. Where was power could be, so to speak, put in question? Here. So it's that simple. It's a short-term power play. And I think the U.S. has all the interest in the world to at least play the comedy of the parts and keep alive this notion, because basically Trump has to deliver the farmers' votes. This is extremely important. And the farmers' votes are going to hinge on China. China trade is in this context much more important than Hong Kong and, for example, the financial community, because they are not going to vote as a bloc. The farmers will vote as a bloc. So you have to split this thing down politically, and you have to split this thing down as a proxy subset of a much wider and far more complex negotiation that is taking place.
Before we go to Europe, I was wondering what to expect from this trading session. As I was talking with my previous guest last week, has been definitely a roller coaster for the US indices. We do notice great performance of Nasdaq because, of course, the tech stocks are definitely boosting the performance of the index, especially compared to its peers. So, what's your take? What do you expect?
Today, what do I expect? I think the markets to open up on relief as to this U.S.-China trade situation. I expect that we're going to look at indices such as the S&P 500, which are very heavily weighted towards stay-at-homes as cyclical stocks, and this is what's boosting the index. You have to realize that, in fact, a lot of the stock buying now is paradoxically a hedge against economic uncertainty, whilst instead of being a vote of confidence in the economy. This is something very complex to understand or to explain even, I think, is that most people say, well, people buy stocks because they're really crazy about the economy and think the economy is going to go through the roof and we're all going to be billionaires tomorrow. What's actually happening here is people are saying, well, you know what? A lot of stuff's going on in the world. This virus keeps spreading. It does not seem to be down and out. We seem to not be at round 15 and maybe we'll have a chance of knocking the virus out. We seem to be at round 3. It's not quite clear who's knocking who out. So you know what? I'm going to play it safe. What happens in these situations? People stay home. What happens in these situations? People don't have much money to spend. And so, in fact, we're seeing some tech stock applications which are actually driving the market, acting almost like inferior goods in microeconomics, those goods that people buy when they think money is going to start running out. This is very important to understand here. And they say, well, whatever happens, people will be on Facebook. Whatever happens, people will watch movies on Netflix, so on and so forth. So I think you have to be very careful between the indices and what is actually happening down below, the bottom up and the top down. But I think it will rise. I think people feel more relieved. You know, at least the US-China is there. That's one front we don't have to worry about too much right away. Europe is picking up, so maybe we'll get some traction from that as well. Because you know what, they will import more of our products, which is not bad, and our subsidiaries in Europe. This is extremely important for US-European stories. The US has massive foreign direct investment in Europe, and these companies will do better and will repatriate part of these cash and also book the profit, will be booked at the consolidated level by the US parent. So that's very important, and that's what could start a shift possibly away from the strictly defensive play we saw yesterday.
Well, let's get very quickly to Europe because situation over here is also extremely interesting. The downturn in the Eurozone continued to recover in June according to the data that we saw today, giving the latest indication of the region's economic health as it emerges from the coronavirus pandemic. Flash Purchasing Managers Index, or the PMI data, measuring activity in both the services and manufacturing sector in the Eurozone, came in at 47.5 in June, up from a final rating of 39.9 in May. The 50-point mark separates contraction from expansion. Economists polled by Reuters had expected the flash June PMI to come in at 42.4. The 15.6-point rise was by far the largest in the survey history, with the exception of May's record increase. So here's the thing, Jan. First of all, what's your comment on the data? Are you bullish on it? And do you believe that the worst is past?
Look, I think the worst was pretty bad. I mean, the worst, you have to understand what the worst was. The worst was basically the complete shutdown. I mean, the end of civilization, so to speak. So now we have emerged. I think we are emerging from the dark ages, so to speak. There's a spiral of light, a bit of flicker of light. I don't think we're yet at Giotto and the invention of perspective, quite frankly. I think we're somewhere in the middle. I think it is good. I think, on the other hand, I think there's still a contraction in place. Orders are falling and employment is down. So this means what? This means that we may have a start here. But that governments have to keep hanging in there. They have to keep pumping money. They have to increase the fiscal spending. The central banks have to keep the companies going at the solvency level. And I think that the EU must finally, so to speak, agree that they can get their act together, as they say in the United States, and actually come to an agreement on this famous EU 750 billion stimulus plan. I think a lot of things still come to place. I see good that they're reopening. I see as good that in France we have not had a major outbreak. I see very positive that the virus situation in Italy is still maybe not optimal, but has improved a lot. And that Spain, this is very important. Spain is a very big economy and very important also politically within the EU. Spain has now ceased or lifted its state of extended emergency. There's still restrictions which are much greater than ever been in the US, but I do believe that in the accounting principle of first in, first out. They were first into the crisis, first to take the measures, including China, and now they will be the first out. And I think they're doing this on a much sounder basis than the US. So I think, yes, I'm reasonably optimistic as long as the government and central banks hang in there. Remember, we are seeing an economy with most de facto or actually direct nationalization than we've seen since 1946. The clock has been set back and we are rebasing our index.
Very quick look also at the spread. Of course, I'm talking about the bond market. It's very interesting because the spread between the 10-year Italian and the 10-year German bond is narrowing so far off 1.80%, 172 basis points. How do you read this data and what do you think about a possibility of the yield curve control? Of course, here I'm talking about a Federal Reserve.
Sure. Okay. Well, first of all, let's look at the spreads in Europe. I think the spreads in Europe will contract. For a very simple reason that there now seems to be some type of agreement between the ECB, the German Constitutional Court, as with the mediation possibly the Bundesbank, Mr. Weidemann, who has said, I will stand up and be your intermediary, if necessary, as to this famous bond buying program. So from the mechanical point of view, i.e. QE will continue and therefore by transversal, so to speak, link, there will not be a threat to the pandemic buying program. So I think you're going to have a mechanical impact there. Now, what is actually happening on the spreads is that we believe that the pandemic buying program is a new version of the gold standard. Now, some are actually saying there's not enough money there because the companies, the countries will have to issue more debt than expected and so on and so forth. But if the ECB can keep, for example, a bond buying program arsenal at a level which is commensurate with prospective bond buying or bond issuing, then I think we're off to a reasonably good start. It shall work like the gold standard. Gold standard said you cannot issue more money than you have gold. This new gold standard says thou risk countries shall not issue more debt than I have in my bond buying fund. So it's going to be a race now to see who can increase faster. Can the bond buying fund keep pace with the issuance or not? And this is really the recovery trade. And I think that until we have a real scare there, we'll probably still see some contraction on the bond spreads. I don't think they're going to converge. I don't think yields are going to converge. That's not. There will always be a discount on high-risk countries.
All right. Thank you very much. John Erga, Chief Economist, Tigers Financial Partners. Have a great day.
Thank you very much. Cheers. Thanks.
Well, before we get on the line, our next guest, I just wanted to show you very quickly the situation on the foreign exchange market. So far, the DXY at the 96.56 mark, euro dollar 1.30, and sterling against the dollar 1.24. In terms of stocks to watch, of course, one of the most discussed stocks nowadays, at least here in Europe, is Wirecard. Have a look at it, 20.87% higher. Former Wirecard CEO Marcus Brown has been arrested on charges of inflating the company's balance sheet. Prosecutors in Munich said earlier today Brown resigned on Friday after the German payment service provider said auditors at Ernst & Young couldn't locate 2 billion euros on its balance sheet. On Monday, the company said it was likely that those funds do not exist. Prosecutors said that Brown turned himself in on Monday evening and would be brought to an investigating judge on Tuesday, who will then decide whether he should remain in custody. Of course, I guess you remember very well, but Wirecard lost more than 65% in the last few trading sessions. So certainly this is a stock to watch. I want to get now very quickly to the foreign exchange market. Certainly very interesting situation over there. And in order to break it down for you, I just want to bring to the show my next guest this morning, Juan Perez, FX strategist at Tempus. Good morning, Juan, and thank you so much for joining us.
Good morning, Alex. Thank you so much for having me.
Well, I just want to kick off with the dollar index. If you have a look at it, it's almost 0.5% lower today. What's the matter with the DXY?
I think it's a combination of what you're finally seeing develop. And again, in the last conversation that you and I had about what were some of the drivers of the euro, those things have really come to fruition, right? Not only are they now talking about passing and the implementation of a package, and of course, even trying to give some incentives to Italy in order to have an increased budget deficit that they can use and they can accommodate for and have a cushion there so they can spend more money. These things were slowly and gradually coming to occur and to really to fruition because of negotiations and talks and the economic data. The economic data really coming in the forms of PMI, and you're also seeing it in the United Kingdom, right? In the United Kingdom, they had the best month they've had, I believe, since 2016 or so in terms of PMI. A return to actual activity, to actual, instead of contracting and thinking recession, we're actually thinking that there actually may be a chance that overall there might be an overall expansion for both the United Kingdom and the euro area. So what's going on also? Not only that a lot of the things that we have talked about have come to fruition, but what is going on in the United States, and I think finally that image is coming to show a picture not necessarily of just doom and gloom, but the situation is dire, and it's dire for many reasons. The pandemic truly was the deadliest in the United States, and even now with the return, most states have had restaurants or 50% capacity in some offices and businesses. And they're struggling. So I think the economic situation overall for the globe, the U.S. dollar it has always maintained a safe haven status, or has even benefited the moment that it seems that there is this feeling that things are going to be okay. But at the moment, even though some things are starting to be okay in different regions, and even China is starting to see this infection go away for the most part, the United States is still the world's largest economy, and it is suffering on many items and many headlines that are certainly not very pro-dollar. So I think naturally what is occurring is that you are seeing not only good data and good narratives in other regions, but finally you're starting to see investors and traders start doubting the U.S. dollar dominance that we have gotten accustomed to.
I was wondering, what's the next target for the euro dollar? So far 1.1327. Do you expect any important changes?
Well, I do, for the sake of the accuracy of my forecast, right? It's always about selfish motivation here, Alex. But the reality is that you and I have said, okay, 115 seems like a long-term, 3 to 6 month prediction, which is what Tempest has had from the beginning of the year. We believe ever since 2019 that there were going to be major recovery items that would eventually lift up the euro, and that has occurred. But the thing is, we're in the middle of the year and it's at 113. We didn't think it was going to be this high, but of course, as I mentioned, there are many items that go from the U.S. relationship with China, then statements that are very sudden and can change the course of whatever thinking or mentality or outlook other people were having, as you had with Peter Navarro yesterday. So these things are the reason why the euro is starting to look like a more attractive asset, because overall on the US dollar pair, and even in the UK with the euro pound pair, the situation of the Eurozone was more cohesive, was more of togetherness, and the Brexit situation wasn't affecting it because by now it's 4 years of the European Union having at least having to get accustomed to the very concept of the UK not being a member. So naturally, the euro could go to that 115. I think that what you're finally seeing is that the 112.50, 113.50 level is merited. It's the level and the ranges that you should give credit to euro, because it deserves it because of the progress that has been made. But right now, we think that this quarter may end in the 112.50. I think that there is vulnerability, and the euro could swing back down. But if it continues to go up, and it slowly but surely could reach into the 115 levels by November, if not October.
What about a risk on currencies? I do see that some of them are gaining back some ground today. What's your take on them?
Well, I think that what you're seeing is, especially in the data, right? The purchasing managers' data, instead of just labor and unemployment and gross domestic product, it is a more future-looking piece of information, and one that in the surveys allows really economists to engage with purchasing managers in saying, hey, do you see this situation improving to the point where you are putting investment and capital into your business? And you're starting to see that kind of happen globally. Now, of course, in South America, you have the situation in Brazil, and of course, those currencies, Argentinian peso, or Brazilian real, have been hammered. But what you are now seeing is that the global growth outlook and the global growth economic narrative is taking place without necessarily paying attention to everything that could go for favor in the dollar, because there are many factors. So that's why you are going to see the dollar index today, especially, and maybe as we go into the rest of the week, really test the dollar once again, as it did 2 weeks ago when it seemed like the US dollar was sinking without end, and then it hit the brakes. So I think that just once again now we're just seeing really we're hitting the floor, because all of the factors that are coming along are more not necessarily pro-China, but they're more pro a narrative of growth elsewhere and not so much here.
Juan, I was wondering, so far we've heard a lot from Peter Navarro, the White House trade advisor. Peter Navarro has clarified that US-China Phase 1 trade deal is not over, and that his comments to Fox News was taken out of context. Certainly, initially that caused a decline of US futures, no doubt about it. So far, all of the US futures, just wanted to show you very quickly, are indicating higher opening. Dow by about 0.8%, S&P 500 up by 0.77%, and Nasdaq Composite 0.6% in the green territory. But if we put aside just for a second the US futures, I was wondering, can we imagine another currency war between the US and China, or this is a not possible scenario, impossible scenario, let's say?
Well, I mean, look, we are here talking today about just how the foundations of the dollar may be crumbling in terms of being a safe haven, and then being in the midst of this ongoing fight with China. Then you have to ask yourself, well, if those two are competing, then what is going to happen here? Is China going to be far more aggressive with the People's Bank of China and on a daily basis like they were before, setting, and they do every day, but are they going to create a very competitive situation in which the yuan is going to be, and remember that we used to think psychologically, is it really going to be above 7? Well, that's become kind of normal. So are we thinking 8? Are we thinking 9? Are we thinking that the yuan may actually become very competitive and just very aggressive based on the headlines that we have seen, right? Because look at what happened last night. Everybody seems to be on the edge of their seat waiting for the worst to happen. And then, of course, a statement is made, and then trying to recuperate yourself and trying to make up for it is very, very difficult. So moving forward, that is the question. Is the yuan going... are the Chinese now going to answer by becoming incredibly competitive and just saying, look, we're going to crush, we're going to flood the markets with Chinese goods. Good luck negotiating with us because you have taken this stance. Or is the United States going to welcome this kind of new, less dominant image that the U.S. has and embrace it and say, hey, look, it might be more expensive to import furniture from Italy, but we're going to start selling agricultural products like crazy too. If China takes it, paints one deal or not, but we're going to be very aggressive on that end. So
right.
The Federal Reserve has acted in a way that has helped circulate a lot of money, and we do feel the dollar will lose dominance. So moving forward, that could be really the case, and it might be the natural flow of being very competitive with China.
Right. Thank you very much. Juan Perez, FX Strategist at Tempus. Thank you so much for joining us. Have a great day. Thank
you so much for having me.
Well, guys, stay exactly where you are, because right now we are switching to our Italian programming right for the opening bell of the U.S. trading session.